right, and welcome in to the special Freight Market Wrapped edition of Freightonomics. As we close out the year, this will be our final episode of 2025. And for many of the participants in the freight market and supply chain in the United States, we're probably saying a lot of, well, good riddance to that. I think I saw a meme the other day, Thomas Wasson, that was basically like, I'm not hearing anybody saying 2026 is my year.
It's not happy. Yeah. I mean, we've been burned before, and that's one of the things. Like at this point, I'm just glad things are going up.
Yeah. Any positive news whatsoever, and hopefully, Dr. Zac Rogers will have some positive news for us here a little bit later in the show. We've got a nice 45-minute episode here, so we'll give him plenty of time to give us the read on the LMI and all the breakdown there. But first and foremost, Thomas, I want to go ahead and talk about the market in two. We got some new indices too.
Oh, hey, Christmas came early. You want me to count you down?
There it is. There's our Christmas present to you. Count me in.
All right, let's do it in 3, 2, 1.
All right, starting things off with the S-Tri, the replacement of the O-Tri. The S-Tri, of course, the Sonar Truckload Index. It is just an expanded version. The story remains the same for the most part. Tender rejection rates are spiking right now. You see that we took a little bit of a pause, and then we're like, no. So they took right off. So it looks like this Christmas has come early for a lot of the transportation service providers out there, as we continue to be in a very volatile freight market leading into the holiday period. Tender rejection rates expected to top 10-11% for the S-Tri, beating last year at this point, which would be a thing. So next chart here, if we pull up the STVI, the Sonar Truckload Index, based off the same data set, this is going to be the expanded version of the OTVI that you guys have become accustomed to. Volumes looking pretty good. Now, seasonally, volumes do tend to jump up, but they are seasonally strong based on where they were. This type of increase was a little unexpected. It's, of course, derivative of a lot of short-haul freight. Looks like fulfillment is really bumping right now. Especially in the downstream markets around Harrisburg, the megalopolis, Atlanta, also showing up for some pretty strong volumes as well. So tender volumes, yeah, they're down year over year still, so weak year over year, but we are kind of growing further beyond where we were based on the baseline of what things were in October, November. Let's go to the next chart. Look at those spot rates. Now, this is what those brokers are going to feel right now. The spot rates, of course, spiking up. We're below year over year, but you know what? I'm not super concerned here in terms of this. Spot rates are very volatile. Mixing becomes a factor as well as long-haul freight and short-haul freight mixes, as well as some of the lane mixing does have an influence. But spot rates spiking just like tender rejection rates. Now, last chart I want to show you is just a little nuance. I have never seen this before where intermodal volumes spiked leading into the holidays. That's
Stranger Things.
That is, I can only, I haven't heard anything about this in the anecdotally yet. I really this is just happening this week, by the way, where we see this, and it is all domestic loaded container volumes moving on the rails that we're seeing spiking. You can see the truckload index, STVI down below that, doing its little spiky thing, but I have never seen intermodal move this erratically, especially you're talking about domestic loaded containers. This is not stuff that's coming right off a port. So I have to think there's some service stuff going on here. Like if shippers are really pushing that much freight onto intermodal in a time of, if they need capacity quickly, I'm assuming, rates out of Los Angeles have been extremely volatile this year. California, of course, having a lot of that pressure from ELP and non-domiciled violations here in the news recently. So I'm just curious here as to why and how this is manifesting in the world. I think this would be, I'm looking to do a deep dive on this one at some point.
We got to get Bound Distal in on that, because one of the things I'm thinking about with that is it tells me two things. Cali is king for intermodal.
Yeah.
We know that Cali flips and truckload rates get higher over Christmas. Mm-hmm. But one of the bigger things that we can tie into the LMI is this because the inventory still we're still not in a hurry, and we're okay with putting it on a train ahead of Christmas. That may be one of the bigger dogs that aren't barking in terms of that upstream to downstream.
Normally, when we see this inventory, and we're going to talk to Dr. Z here in a minute, and I'm loving to get his thoughts here. Inventory levels look like they were tightening heading into the holidays. And it's like, demand forecasts were a little bit softer because we've got this policy uncertainty, yada, 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 all the things about 2025 that still persist. And if inventories are low and all of a sudden demand is still there, you get this sense of urgency from the shipping community. Normally, they don't think intermodal when that happens. Normally, it's like you got to throw it on a truck because intermodal, UP has not merged yet. So the transloading factor in Chicago, you add a couple of days there of service. Like, we're only, at the time of this, we're 14 days away from Christmas. So there's not a ton of leeway.
Close.
Yeah.
You're kind of close putting it on coast to coast on a train. And that's one of the things I'm curious about is that because when we think about intermodal, one of the big conversations has been they handled a surge. So they have really cleaned their act up together. Like when you go to the gym and you work on yourself and now you're in a good place right now. Well, I would say one of the unsung conversations in the intermodal thing is that not only did they increase the share of containers, we saw a lot of truckload carriers like Hunt expand intermodal. It became an area of growth, but also they've put in the work. They kind of, when you read those books on like self-help and you're going through my glow up phase, I think rail has seen the glow up in 2025. And I think for shippers that, this is my ESPN talking point idea. I feel like there's just a lot of trust in intermodal right now because they handled the big July 4th boom that we saw in some of the data sets and looking at O-rail and container volumes. That tells me that it's a cheaper rate.
Yeah.
I'm still not in a big hurry, and I can kind of just wait and do my homework until 3 days later because capacity is still plenty enough. That's something that's definitely worth looking at because in our high frequency data, this is like a aha moment.
Oh yeah, it's very quick. Nobody's going to see this quickly. But also, I wrote a chart of the week a few weeks ago about Los Angeles spot rates and contract rates on the truckload side have expanded dramatically over the last 2 years. And whereas intermodal rates have actually come down in that lane, I think it was Los Angeles to Chicago, which is obviously the main thoroughfare for intermodal and transcontinental freight. And I have to think that's part of the reason these shippers are still kind of like, that's a cost-effective, compared to trucking, I'm going to be able to get it most of the way there. Yeah. And then I would think that drayage and all sorts of other things would come into play this time of year, but I don't know.
The other question I'm thinking is when I make a deal with the rail, is it for a certain amount over the course of the entire year or is my allotment per month? Because the other thing I'm thinking if I'm putting on my hat is what if I know that I'm supposed to ship X amount of stuff, but I've been holding back? Now's a great time to get my full allotment and stage some stuff. There has to be something also deeper to it terms of maybe it's just get it while it's good. I didn't use all this extra capacity. I've got X amount of allotment on the rails. Let's get it all out here because 2026 may be even crazier and I'll just stage some stuff. So there's definitely a few areas and, rail has so many different things that there's a few tweaks that we may be missing. This data is telling us something, but we got to put on our little detective hat.
Where there's smoke, there's fire. Bowden Distal, if you're watching. Start digging, man. Maybe we'll put out an article. All right. So we had a big announcement yesterday from the Fed. This is Freightonomics. We're going to talk economics as well as freight. If you're not partially an economist at this point, working in the freight market this year, supply chains, you should be. It is. You need to go ahead and embrace some of this rhetoric. I myself have really had to dig in this year as we've had a lot of economic activity that has had a lot of downstream influence on supply chains and freight market movements and things like that. We had the Fed decide to cut rates. Here's my big takeaways. So Jerome Powell, of course, everything's political in 2025 now. And so he has done a fantastic job. I have been critical of him in the past, and who am I to be critical of this man? But I thought that he raised interest rates too quickly and too aggressively and too late I didn't think that the Fed had enough data to make good, clean decisions on this policy because we work in freight market. We're down here in the bottom layers of the economy. We see freight movements. We're dirty. We're in the weeds of it. We got high frequency data, not this 2-month lagged stuff that they're making decisions on. And so I've been critical of his policies in the past. And again, who am I? But I thought he has handled the noise of the politics kind of invading his space this year very well. And I think that he did a good job yesterday of sticking to the facts of the data in terms of the way he views it, mind you. Doesn't mean I have to agree with all of it. But my big takeaways were they are more concerned about the labor market than inflation at this point. He goes on to state that inflation is having an influence on durable goods. He's seeing only inflation in goods. He said there's disinflation. I'm not really sure if that's the right word, but
deflation.
Yeah, I normally call it deflation, but disinflation in services. So economically speaking, we're a services economy.
Yeah.
So economically speaking, that's not a great sign for us overall, but I think he's saying that I can't do anything about the inflation that is occurring in goods because that's not me. And I agree with him on that aspect because moving a quarter point down isn't going to take away inflation from a lot of these goods. And it certainly won't happen for another 9 to 16 months. And then my next thing is, he no longer sees this labor market as being low unemployment. We've ticked up now. We're now and he even admitted that the data that we've had on the employment figures has been consistently revised downward over the last year.
Like 60,000 a month potentially in terms of more revisions based on those numbers. That's a scary thought because it's like a K-shaped economy right now.
So the good thing here is that he's acknowledging the consistent flaw in the data reporting that he's getting and accounting for that in his projections. So that's a good thing from a data perspective. Still a strong level of uncertainty heading into 2026, but he does say that he thinks that we are in a good position to kind of wait and see from a neutral rate environment, as he calls it now. We're no longer restrictive. And I think, one of the takeaways is that the GDP forecast for the next year was raised above 2%. We're now at a 2.4% GDP now that we've cut rates. We do see some economic stimulus in some of the big, beautiful bill stuff, as well as, I think everyone's hopeful for the uncertainty cloud to kind of start resolving itself. He alluded to these things. He did not directly address them, and he was very purposeful in a lot of that. But I think this policy back and forth, nobody understands the division between politics and policy at this point, and what has purpose. And he did acknowledge that debt was still a factor and a problem for the future. He does not think that's going to manifest in a meaningful way near term, but he did talk about how the debt was a concern later.
Like our $40 trillion debt.
Yeah.
He said it's not an immediate problem. Well, I mean, it's kind of like being a football coach. That's next season. That may be the next coach's problem.
Right. And of course, we're going into retail season. There's been a lot of reports about debt and credit card debt and everything. I did some high-level research on this. Total debt, credit card debt in the United States, $1.2 to $1.3 trillion. There it is right there. And then we've got the average per cardholder is $6,500 per cardholder of average debt. And then, of course, average per household, $9,000 to $11,000 of credit card debt. We need to get Dave Ramsey on and talk about some financial management practices for the United States consumer. Growth continues year over year. But one of the interesting things to me is because I thought that this was going to accelerate growth, it actually has slowed a little bit year over year in terms of total credit card debt growth. So that I think is a good thing, but we're still holding more debt than we were. Like, it's not like the growth has slowed, debt has not come down. So, and when you're talking about the average APR or APR, I forget what show that's from, it's 20%, a 20% average APR. So you're spending 20% more than you're actually spending when you think about it that way. So the debt is a concern from the consumer aspect. You were talking about it from the government aspect. And then, of course, we've got retail peak season. So, I think this is going to transition well. We've got two stories to cover here before we get to Dr. Z. But these are what I would consider the two main themes of 2025. We've had this trade policy back and forth, tariffs on off, cost prohibitive tariffs, 145%.
Situationship.
Yeah, we've had this huge undulation in imports over the last year, but ongoing uncertainty and rising tariffs are projected to significantly suppress U.S. import cargo demand, a trend into 2026, according to the National Retail Federation. Container imports over the last year have started to soften dramatically. Volume totaled 2.07 million 20-foot equivalent units in October, down 1.8% from September and 7.9% year over year. That trend is expected to continue through the rest of the year. So we're down year over year, total container imports. So from a retail perspective, demand softens. Now, some of this I would be considering as pull forward. We had this early peak season this year. If we pull up the IOTI, you'll see the big undulation and the big spike in June, July on the IOTI. There you go. Very unseasonable spike, a little exaggerated, and also recovery mode. But now we're down, and we're not really seeing any undulation here. Retailers just aren't. They're not concerned about their inventories.
And that ties into that intermodal conversation we had earlier. Why the heck are we seeing a spike? Well, look at this. There is capacity. They handled it at the very peak, and they did not break a sweat. And now we're about nearly 8% lower on a year-over-year comp. I mean, if I'm an intermodal guy, I'd be thirsty too, trying to cut some rates, be like, look, I can give you an extra day, you know?
Yeah, that's a great point.
There's an opportunity there.
Mm-hmm. The next story, before we get to Dr. Z and the LMI, of course, all the regulatory pressure on the truckload space continues. Please, there's a couple of articles. Sean Robinson wrote one. Noy Mahoney writes this one that I'm going to reference here, but very well covered from my perspective. The FreightWaves team's doing a great job here. English language crackdown exposes how cheap labor fraud reshaped trucking industry. Now, I'm going to just summarize this very quickly from my perspective. We've ranted on this. You've ranted on this to an extent. Remove the immigration and the politics of it. The trucking industry has had such a significantly low barrier to entry for the last several decades. After regulation or deregulation in 1980, there's almost been no money or effort put into this space for enforcement of what regulations did exist.
Yep.
And some of these were lobbied by entities such as the ATA, trying to remove some of these barriers to entry, as the driver shortage was the main problem that we've heard about for several years. Not really a driver shortage issue. It's a driver recruiting and maintaining issue for the most part. So mislabeled there. And a lot of this is just, and you know, we're not going to rip this Band-Aid off all at once. It's just a lack of funding and focus on enforcing some of these regulations that are very safety-centric regulations, but they haven't really been allowed or given the resources to enforce a lot of these things. And it's allowed for a lot of low-cost operators. Yes, some of them are foreign, but there's also some that are not foreign that are pervasive in all states throughout the United States.
It's a supply and demand. It's an economy problem. So you remove all the, and that was my 30-second mini rant. It's incentives and it's, like you said, regulations. And we've lowered the barriers to entry. We've set up an opportunity where you can come in, you can undercut, and the safety's had an impact as well. But I think that's one of the big things is that people get very emotional about this because of the fact. But at the end of the day, I think we saw deregulation in the 80s, started this trend of lower barrier to entries and deregulation. I think that we have hit the peak, the lowest point, and the tide is coming back in. And I think that's one of the big structural things to say is over the next 12 months, we will see a significant structural rebalancing in the for-hire truckload carrier space.
Yeah, and I think a lot of the reported figures have been a little noisy. I don't see any validity there outside of, we're seeing spot rates spike right now. So there's clearly some sensitivity in the market, whether that's allocated to some of this regulatory enforcement, or I think more of it's just allocate to the market conditions of a 3-year freight recession. Like, these guys they're going out of business, and they're going out of business because their balance sheets are so bad right now and the debt levels are so high. Let's pull up the ELP chart here, the English language proficiency reported by the DOT. This is alarming to me. This is the point. So they weren't enforcing this until this year, and you see how quick the ramp up was, and averaging several hundred of violations. I showed this chart last week or 2 weeks ago, whenever it was. And then the out of service figures down there, we're rolling around 70, 80 out of service per week on average, English language proficiency violations. So they're now enforcing some things that they probably should have already done. And that's, it's not just English language, non-domiciled, getting a CDL, the ELP, the ELD enforcement, like where you have standards over the device that manages your hours of service.
Yeah.
You've got people that are playing by the rules, and then you have people that aren't, and they're doing it cheaply. And that's what's creating this economic imbalance in the space. So you don't want to reward people for breaking the rules and also punish the people that are actually playing by the rules. That is the problem in the space right now.
I want to see that if we can ever get the chart all the way back to pre-14 or before the Obama era stuff. That's one of the things I want to see is how much are we doing compared to the past? And then this is another noisy chart because out of service percentages, you can just fly in another driver and just do a swapsies. One of the things I want to remind folks is while everyone's focusing on this whole labor, immigration, and ELP enforcement aspect, the national out of service rate is between 22 and 24%. And usually that's maintenance and other things. So already everyone's missing the punchline of the joke. 1 out of every 4 trucks is not fit to be on the road. And we've been having this for like decades. And so this is a really fun chart. And I hope we continue to actually enforce the rules. But if you can't even get 1 out of 4 trucks to pass an inspection on a good day, we do have some structural house cleaning we need to do.
I do highly recommend finding the ELD article as well, written by Sean Robinson, and reading through some of the enforcement or the lack of accountability in some of the manufacturing and the technical specs. Like the FMCSA is not entirely to blame here because they don't have the resources to enforce a lot of this stuff. And, you can agree with ELDs or not. When you're talking about, well, I'm playing by the rules and these people aren't, that's where I start to see the economic divergence, and that's not okay.
Best part is everyone cheats. My final spicy take on that is I came from truckload operations. I know safety and compliance. It's a structural issue with the ELDs. Most of them piggyback off of cell phone signals. So when you see these ELDs getting put out, those are the ones who got caught. It's called unassigned trips, people. If you really want to understand how the sausage is made, you basically assign another driver profile to the unassigned trip, and you can get more hours. And that is a finagling that every fleet does because that is a problem of the ELD. When you go through Moab, you're going to have a 100-mile unassigned trip, and sometimes a less scrupulous person would assign it to Jim Bob instead of Terry, and now Terry doesn't have a false log violation. That happens everywhere. So the other part of my joke, I'm on a comedy routine today, Thursday, is that this is actually a much larger problem than folks understand, and we are just the tip of a very nasty iceberg.
Amen to that. So without further ado, let's get back to the business at hand of wrapping up 2025 with the supply chain expert, associate professor out there in Colorado State, where I hope that it's going to snow so much that this man gets trapped and I can go out there and ski fresh powder at some point. Dr. Z.
Hey, I mean, you could come ski without me getting trapped. That's fine too. There's snow in the mountains and sun in the valley where the people live. I mean, we have the technology. Both can exist.
I don't know, man. I think I dream about the white fluffy powder out there, and I want there to be abundance of it when I go.
We had 4 inches last week. So, I mean, none now, but it'll come on out. Well, you can get to snow literally 12 months out of the year if you come to Colorado. We just got to go high enough up.
I do love the mountains. All right, let's get to the supply chain environment here. You just had the LMI come out.
Yeah.
I did not read the report yet because you know what? I was like, I'm going to end the year feeling surprised. I want you to summarize it for me. I want you to tell me. I want you to give me the lead in and the spicy takes that you took away from it. I did see some warehousing surprises and shocks that I want you to talk about, but I'm sure you will. Let's get out.
I will. Well, coming in and saying, "Hey, I didn't do the reading. Can you tell me what was happening?" That's actually good practice for me going to class here in about 2 hours. So, So the overall index in November was down to 55.7. So that's a 1.7 point drop. And that is actually a fairly low reading for us overall. I mean, it's actually our lowest reading that we had in 2025. It's the lowest one, I think, going all the way back to June of last year. So it's a bit of a dip. Now there's still growth. And when you look at the dip, it's very similar to what we had in October. It's the result of cross pressures. And the cross pressures are inventories and warehousing slowing, transportation picking up. It's actually very consistent, I think, with some of what you guys were showing a minute ago with the tender rejection volumes and everything. Essentially what happened in November, and really this kicked into overdrive in the second half of October. And then really second half of November, we saw this crank up. Inventories are really starting to level out across the supply chain. You know, all year we've been coming on talking about the middle mile, and there's all this stuff stuck at the wholesale level. That is not the case now. You know, if you compare inventory levels for our smaller upstream folks and our larger downstream folks, like small versus large, it's like 52-52. If we look upstream at the wholesale level where they had been having huge inventories all year, in November, they came in at 46.3. And so we're finally, after, I mean, you saw those spikes in port stuff and the chart you guys showed a minute ago. We've been having so much inventory at the wholesale level, just crushing these folks in the middle. Finally, we're seeing relief. They're at a 46. And it's clear where it's all going because downstream inventory levels came in at 65.8. So it's a 20-point swing, basically, going from the upstream to the downstream. Why did that happen? Well, because we really got the holiday season kicked off in earnest. You know, we had $43.85 billion in online sales alone over the Thanksgiving weekend, like going from Thanksgiving to like Cyber Monday. $43 billion of stuff moved just in e-commerce. You know, the days of elbowing your elderly neighbors to get to the good TVs at the back of Walmart on Black Friday, those are gone. Now people are just sitting on their phones, you know, ordering the TV and it can show up to your house. Well, most people. I actually spent Black Friday watching CSU got killed by Air Force, but most people, you know, that was also a fitting cat for the year. Yeah. But so we have these movements in inventories, right? And what's interesting is it hasn't had much of an impact on cost. So inventory levels are at 52. That's like sort of bare minimum replenishment. And again, that's mostly because of the 65 downstream. Perfect. Exactly the line that I wanted to see. Look at the difference between the white line and the purple line. We still have not had the convergence that we expect. Like if you look back, kind of going from 2022 to the beginning of 2025, you see that for the most part, the white lines and the purple lines, right? So the white line is how much inventory do you have? The purple line is what's the cost of the inventory. They move together. That has not been the case really since about April. By the way, did something happen in April possibly to change the cost of inventory?
I'm not sure. I'll have to look at my notes.
Some with an L. But so we've seen this sort of delta. It's still about 20 points. And what that's doing is it's put a lot of cost pressure in the middle mile and cost pressure on the consumers. You know, you guys were talking about old Jerry P a minute ago, and what he was saying about the cost of goods. You know, something I always look at is the breakdown about drivers of inflation from the San Francisco Fed, my favorite branch of the Fed. I think everyone should have one. My favorite, Adam Shapiro. September is the most recent data we have. 68% of the inflation that we had in core PCE in September was supply-driven inflation. Only 32% is demand. And that's what Powell means. Mm-hmm. There's nothing the Fed can do to impact the cost of that supply inflation. And that's what's getting picked up with that 70 number. Now, for reference, our supply inflation in September was 75.5. So it's slowed down a little bit, but I would expect to see supply inflation stay sort of in the ecosystem, in impacting PCE. Even now, the rate cuts could do a little bit for it. We've had 3 in a row now, but I would expect that supply inflation to be fairly consistent because, you know, we've paid an extra $65 billion in tariffs in the last 3 months relative to what we would have paid over the same period a year ago. Okay, so the inventory's moved. Great. Let's talk about the surprises in warehousing. So one of the things we saw, warehousing capacity ticked up, which you would expect, so we're at a 54.8. And again, you know, we're finally seeing some relief upstream. They were at a 54. What's interesting is for the first time ever, warehousing utilization was negative. So we have 2 metrics going into this month that had never gone negative before: warehousing utilization and warehousing price. It's nice to be in industrial real estate, actually. The price never goes down. And it's like cable. The price goes up, it never goes down. And so warehousing utilization goes down this month. It took a 9-point dip from 56.5. Yeah, look at that, to 47.5. And so we had a real drop off in our warehousing utilization. Again, that was driven upstream. Our upstream respondents, again, this wholesalers, distributors, manufacturers, read in at 44.2. Downstream was 55.6. Warehousing prices for both were in the 60s, so there is still some slight growth. Again, though, that's mainly driven by the fact that now inventories are going to downstream warehouses, and downstream warehouses tend to be closer to where people are, and so they're more expensive, labor's higher, all of these things. And we're seeing a quick turnover through the warehousing system, especially at the retail level. So we have finally, and now just to put that 47 perspective, does that mean we're having a warehouse crash? No. What it really means is that we had so much inventory. Like, we had an unseasonal amount of inventory for basically 6 months, and then it all started draining out and going down to the retail level. The plus side of that, in terms of logistics activity, is in transportation. So this is our best transportation reading of the year, essentially. We had transportation capacity dip down 4.5 points. So it went from a 54.5, which was growth, to 50. So a 50.0. This is only the fourth time since you can see that big dip on that yellow line right there in April of 2022. That was the beginning of the real sort of freight recession we had. This is only the fourth time that we've been at 50 since that recession started. Okay, so one of the things we've been waiting for literally 3.5 years at this point is for us to finally move past the reserves of transportation capacity we built up during COVID. We so overbuilt in 20 and 2021, and understand why we did that. That every time transportation price has gone up, we've gotten down to 50. And again, this is the fourth time it's happened. We've gotten down to 50, but we've never gone into contraction for capacity. And because of that, there's been sort of a hard cap on transportation prices. We went over 70 once. That was in January of this year when we had the big rush suddenly in pull forwards. But we've never had those high highs. And you can see at the beginning of this chart, that the beginning, the left side of this chart here is 21 and 22. That was like the real, bust freight market. We haven't been able to get to those highs because we haven't seen capacity dip down below 50 in 3.5 years. Now, interestingly, we're about halfway through December. Halfway through December, we are a little bit below 50 on capacity. So it does seem like we are really seeing some utilization. Again, this is really driven by the whole supply chain. We break it down into small and large respondents. Both of them are exactly at 50. We break it down into upstream, downstream. Upstream's at 49, downstream's at 52. I mean, everything is right in this zone, basically, right around no movement. And because of that, price is fairly elevated. That split where right now if price is in at 64 and capacity is at 50, that 14.9 point split is exactly what it is. It's our largest sort of positive delta in like 2.5 years. And when we compare it to where we were in August, September, and October, I remind you guys, we had a negative freight inversion in August, September, and the first half of October, where capacity was actually growing faster than prices. And so it's been a real turnaround in the last couple months. And it's kind of what we were expecting to happen all year. We had all this inventory that was stuck. Everything was static. And then holidays started and we went from, potential energy into kinetic energy. And things are really moving now through the supply chain. And it's really driven downstream. Our retailers reported transportation prices at 70.6, which is the highest they've reported since the Christmas of 2021, basically.
Right.
We're seeing a lot of energy downstream. Now, is that going to continue after the holidays? Great question. But for right now, we're seeing some healthy movement in transportation because that inventory that's been stuck is finally moving.
I wanted to zoom in on that. One of the things that the LMI does a great job of, it reminds me of Ghostbusters when the streams cross between transportation capacity and transportation pricing. And one of the big things I noticed was that in the LMI data, typically once the streams cross and they start inverting, we start to see the next steps of the freight cycle. Do you think this is something where, as we're looking to 2026, any prognostications, do you think this may be another pump fake, or do you think it's the early signs of some green shoots just based on this responded data?
Well, what's interesting is that we always ask folks, hey, going forward, where do you see this, 12 months from now? And 12 months from now, I mean, according to our respondents, transportation looks pretty good. They're expecting 1 year from now capacity to be at 47.8 and prices to be at 78.4, which would be a fairly robust rate of expansion. And it's one that's really driven on both sides, a little more actually upstream, because upstream came in at 44 for capacity in the future and 80 for price in the future. So, I mean, it does show quite a bit of movement, but at the same time, what it shows is very low inventories. And I think this actually gets back to what you guys were talking about with intermodal earlier, where the solution in 2025 to tariffs and all this, the cost changes and policy changes, was pull forward as fast as we can. Get everything pulled forward really early. It's one of the reasons actually why, I know you guys mentioned this earlier, I wouldn't pay that much attention to year over year import stuff starting about now. Middle of December was when the big pull forward really started.
Right.
It started 6 weeks after the election, which is about now, a year ago. And so, like, if you look at like Port of LA numbers, right? The Port of LA, this week we're up 10%, but the week of December 21st, down 20%. You might be thinking, oh my gosh, down 20%. That's so crazy. Are we falling apart? No, last year was nuts. So I think the year over year stuff is fool's gold at this point in some ways, especially for December and January. But so anyway, last year we did the pull forward. This year, what are we going to do? Lean and mean, because the costs are already here. That big supply inflation that we talked about, the extra $20 billion in tariffs every month, that's here. And so how do you deal with that? You run everything as lean as possible. And I think that means longer lead times. Okay. We're having less rush. We're bringing things in sort of slowly, but consistently. And it's one of the reasons I think intermodal might continue to be strong next year, is because based on what we're seeing from our respondent predictions, inventories will grow, but very, very slightly. The average predicted growth is 56. Average predicted cost, though, is 72. And so we'll keep bringing inventories in, but we have to keep them lean because the cost of the inventories will be higher. And because the cost of inventories will be higher, we're probably going to hold less. So we're seeing softness in warehousing, 58.2 for capacity, which means we're adding capacity. At the same time, costs are 75 because, again, warehousing prices.
Right.
But then transportation, 47 for capacity, 78. And basically what that tells me is we're going to almost like a JIT with high costs maybe, but a JIT type situation where we're going to keep inventories as low as possible. And the way to do that is to turn them over as fast as we can. And so if we're turning inventories over quickly, that probably means we're going to see strong utilization in the freight market. Now, this assumes some things like, demand doesn't drop out,
right,
or anything like that. And I am actually seeing, I would say there's been a real divergence. You were talking about the K shape earlier, yeah. Thomas. If you look at small versus large firms, we said earlier, all this pressure from tariffs has been in the middle of the supply chain. Well, the supply chain is where the smaller firms tend to be, okay? And I pulled the ADP employment numbers. We always break down our small versus large stuff, and small has had such higher transport or logistics costs all year, other than transportation because nothing was moving after July. But inventories and warehousing costs were so high for the small firms all year, and I think we're seeing some of the cracks of that. If you look at the last 3 months. And this is from the ADP reports because we're not doing, government reports anymore. This is from the ADP reports, September, October, and November. Okay, so the last 3 months, firms with 500 employees or less have lost 160,000 jobs. Firms with 500 or more have gained 145. And so this gets back to what you're saying about this K-shaped economy. Now, our respondents are pretty evenly divided from the large and the small. So I think our numbers travel across both, large and small. But I do think it's something to look at, that the brunt of the tariffs has really been on the small firms. We're seeing some cracks of that. And whether or not that manifests itself in any change of demand, which then could change these future freight predictions, that's something to keep an eye on. For now, though, the only way that it seems like our respondents can figure to keep inventories low, to keep costs low, is to really move in transportation. So I would expect to see, 2025 was all about static inventories. 2026 looks like it'll be all about dynamic inventories.
Now, of course, the big risk to this, and you alluded to this fact, is in the demand forecastability, and that's something that the shippers and companies have not had a lot of confidence in of late, to say the least. So how exposed are they to? I mean, I think most forecasts at this point have been to the downside, which doesn't leave you much room to fail if you miss to the high side. So if demand spikes were to occur, that feels like something that a lot of these companies and businesses are kind of foregoing at this point because they see more downside demand risk than upside demand risk. Is that something you see in the data?
Well, that's been the funny thing about this bifurcation and putting everything in the middle mile. The large, powerful retailers have been very risk averse this year. Right. Inventories have been so low for large firms. If you look at sort of, we always break out large inventory levels versus small inventory levels. In the 7 months since April, when Liberation Day happened, large firms have reported inventory contractions 4 times. Small firms have averaged inventory levels in the 60s. And so it's, I just wrote an article about this. I think I told you about it last time. JIT for me, but not for thee. That's what we're doing for this. So it's JIT if you're a big, powerful firm. If you're one of the small firms, sort of in the middle of the supply chain, not for thee. And so they are the ones who have been holding all the inventories. Now, I would guess that dynamic's going to shift in 2026 because we won't have the pull forward.
Right.
And so it'll be interesting to see if sort of that risk aversion and that real leanness that we saw downstream starts to manifest upstream for the smaller firms as well. I would say, though, I mean, look, we're having like the worst consumer confidence reports ever. And at the same time, we just had the biggest Cyber Monday ever. And so Americans, we're a fickle folk. It's still going to be Christmas in 2 weeks. It's still going to, we're still going to have shopping. I mean, to me, what it seems like is some of the consumer confidence stuff now is so tied up into political sentiment where you're like, yeah, man, everything's terrible, but we're still spending money. And, I would bet on Americans to keep spending money until they show me that they're not going to. And that seems to be, again, with a grain of caution there because we're going to be leaner, that seems to be the approach that our future respondents are looking at as well.
I mean, never doubt the American consumer. I think Anthony Smith, I think he coined that phrase, actually. Man, so, all right. I mean, again, I'm still kind of cautious about this inventory management in 2026. I don't, the Jerry Powell comments didn't make me feel super comfortable with where everyone kind of stands with the forecast of 2026, even though we did get a little boost in GDP. The markets obviously love rate cuts. So I guess we'll see.
It's the employment piece, though. That's the thing that we don't know, right? We've seen these cracks clearly. Lost 160,000 jobs from our smallest businesses. If that sort of leaks downstream to the bigger ones, that's when we're going to have an issue. Inflation has not really softened.
Right.
But employment being decent has kind of kept us. We're the no hire, no fire. We really need to get into no fire, yes hire. And then I'll feel better about those.
Listen, I got a credit card, man. I'm covered. 25% APR. So, Dr. Z, thank you so much for wrapping 2025 with us. Hopefully we have some, something to talk about in 2026.
We'll know when we know.
Fairly positive. What do we got for Christmas break, man? You out yet?
Today is the last day of class. So I'm
There you go.
talking to you, and then I'm going to go review a final, and then you won't see me again until, I don't know, February.
February, March,
Have a
April.
Merry Christmas, Happy New Year, all the holidays, sir. Appreciate it.
I'll come back in January for you guys. I'll wake up out of my 6-week nap. And
I'll come find you.